Hey everyone, thanks for coming back to the channel. Today we're talking about Nvidia, ticker NVDA, and I'm going to start with a simple question. Is Nvidia still the best AI stock in the world? Or is the easy money already gone? Because Nvidia is not a normal stock anymore. It's basically the heartbeat of the AI boom. When Nvidia moves, the entire AI market moves with it. So in this video, I'll break Nvidia down in plain English. What the company actually sells, why it's been so dominant, what could keep it compounding for years, and what could go wrong and crush returns from here. And since everyone asks this first, let's put price targets on the table right away, within the first couple minutes, so you understand the risk and reward. At the time of recording, Nvidia is trading around $201 per share. That's roughly where it recently closed. Here are 3 realistic scenarios. Bear case. If AI spending slows, competition heats up, or margins compress, Nvidia can absolutely pull back hard. In a bearish scenario, I think a realistic downside range is roughly $150 to $175. That's a painful drop, but it's the kind of drop high-growth megastocks can do when expectations reset. Base case. If AI spending continues, Nvidia keeps executing, and growth remains strong but not perfect. A reasonable base case over the next 12 months is roughly $250 to $275. That lines up with what a lot of Wall Street price targets have been clustering around. Bull case. If AI infrastructure spending stays aggressive, Nvidia maintains leadership with its next platforms, and earnings keep surprising to the upside, you could justify a bullish range around $300 to $360. Now, quick note, so this doesn't sound like I'm predicting the future. Those are scenario ranges, not guarantees. But they're not random either. They're anchored to the fact that many analyst targets are sitting in the mid-260s to mid-270s range, with higher targets reaching into the 300s depending on the analyst. Okay, with that context, let's make Nvidia simple. Nvidia makes chips, but that's not the full story. Nvidia is really selling an entire AI computing platform. Hardware, software, networking, and an ecosystem that's extremely hard to copy. Most people know Nvidia from gaming graphics cards. That was the old world. The new world is data centers. And data centers are where the AI money is. Here's why Nvidia became the king of AI. AI models need massive parallel computing. GPUs are extremely good at that. And Nvidia spent years building a software ecosystem around GPUs, so developers can actually use them easily. So Nvidia isn't just selling a powerful chip. It's selling the default environment that most AI developers and companies already build on. That's the moat. That's why this has been so hard for competitors to displace. Now let's talk about what the business looks like today. Nvidia recently reported a record quarter. Quarterly revenue was about $68.1 billion, up big year over year. And the data center segment alone was about $62.3 billion for the quarter. Full-year revenue was about $215.9 billion. In other words, Nvidia has turned into a data center company that happens to also sell gaming GPUs. And Nvidia guided the next quarter revenue around $78 billion plus or minus 2%, which tells you management still sees strong demand in front of them. So the bull story is obvious. AI is still expanding, and Nvidia is the picks and shovels company. But the bear story is also obvious. Everyone knows this. The stock has already run hard. So the question becomes, what has to be true for Nvidia to still outperform from this point? Let's walk through the bull case first. Bull point number 1. AI infrastructure spending is still early. A lot of people think the AI boom is basically done because Nvidia is already huge. But the more realistic view is that we are still in the build-out phase. Companies are building AI factories, governments are building sovereign AI, cloud providers are building capacity, enterprises are adopting AI slowly, and that requires compute. If you believe AI is as big as the internet, then the infrastructure build-out could last years. Bull point number 2. Nvidia's platform advantage. Nvidia has a hardware roadmap, but it also has software, libraries, developer tools, and years of optimization. It's not easy for a competitor to just show up and say, "We built a chip." The chip is only part of the value. The ecosystem matters. This is why Nvidia can sell not just chips, but full systems and networking, and why customers keep buying even when competitors exist. Bull point number 3. Pricing power and margins. When you're the default platform and demand is high, you can maintain strong margins. Nvidia has had incredibly strong profitability, and gross margins have been very high recently. If Nvidia can keep margins strong while growing revenue, earnings can compound faster than revenue. Bull point number 4. The platform shift from training to inference. Here's a key thing most beginners miss. Training big AI models is expensive, but inference is where AI becomes everyday reality. Inference means using AI constantly in products. Search, assistance, enterprise workflows, customer support, coding tools, everything. If inference explodes, demand for efficient compute and networking can stay strong. And Nvidia is positioning new platforms specifically around better performance and lower cost per token, which matters a lot for inference economics. So that's the bull case. Continued capex, platform moat, strong margins, and a long runway. Now let's talk about the bear case, because this is what protects you from buying a great company at a bad price. Bear point number 1. Competition and custom chips. The big cloud companies hate being dependent on one vendor. They have every incentive to build their own chips, optimize their own workloads, and diversify away over time. Even if Nvidia remains the leader, share can be pressured at the edges. Also, AMD exists. Other accelerator companies exist. And there are custom ASICs. Nvidia doesn't need to lose leadership for the stock to underperform. It only needs growth to slow from insane to merely great. Bear point number 2. Demand cyclicality and capex pauses. AI capex can feel unstoppable until budgets pause. If the economy slows, if cloud providers slow spend, if there's a digestion period, Nvidia revenue growth can decelerate. High expectations plus decelerating growth can lead to multiple compression, which means the stock price falls even if the business is still strong. Bear point number 3. Customer concentration. A large portion of data center demand comes from a handful of mega customers. That's not necessarily bad, but it does increase risk. If just a couple major customers change spending plans, the impact can be meaningful. Bear point number 4. Regulation, export restrictions, and geopolitics. Semiconductors are strategic. Restrictions can change demand patterns and affect certain regions. It's not always predictable. Bear point number 5. Valuation. This is the big one for investors. Nvidia can be an amazing company and still deliver mediocre stock returns if you buy it when expectations are too high. The market doesn't reward great. The market rewards better than expected. So how do you analyze Nvidia without getting lost in hype? Here's a simple framework. 4 things to watch. First, data center revenue growth trend. Is it still accelerating? Is it steady? Is it decelerating sharply? Because data center is the engine. Second, gross margin trend. Are margins holding? Are they compressing? Margins tell you how much pricing power Nvidia has and how efficient the mix is. Third, networking and systems traction. AI isn't just the GPU. It's connecting hundreds or thousands of GPUs together. Networking becomes a major part of the platform. If networking continues to grow, it strengthens the ecosystem. Fourth, guidance and order visibility. Nvidia's guidance is a huge signal because it reflects demand and supply capacity. If guidance stays strong, it supports the thesis. If guidance suddenly softens, the market will react fast. Now let's explain the Nvidia story like you're new, in one simple mental model. Nvidia is selling compute the way an oil company sells energy. AI needs compute. The more AI grows, the more compute is needed. And right now, Nvidia is the main company selling that compute at scale. So if you believe AI keeps expanding, Nvidia benefits. But if you think AI spend peaks or gets interrupted, Nvidia can still be fine, but the stock may not be. Now let's talk about what kind of investor Nvidia is for. If you want stability and low volatility, Nvidia might be too intense. This stock can swing hard. It's a mega cap, but it trades with high expectations. If you want exposure to AI infrastructure and you can handle volatility, Nvidia can make sense as a core AI holding. But you still have to respect entry price. Here's a practical approach that avoids common mistakes. Instead of trying to perfectly time Nvidia, think in ranges and position sizing. If the stock runs far ahead of fundamentals, you don't chase. If the stock sells off on a short-term scare while fundamentals remain strong, that's when long-term investors usually get better entries. Now let's revisit the price targets quickly with that in mind, because this is where people get tripped up. At about $201, Nvidia is not priced like a maybe AI works stock. It's priced like a AI is definitely happening and Nvidia stays a leader stock. So the upside comes from Nvidia beating already high expectations, not just meeting them. That's why the base case range around $250 to $275 makes sense if execution stays strong and the market remains supportive. That aligns with broad analyst target ranges being in that neighborhood. The bull case 300 to 360 requires continued upside surprises and strong demand staying hot. And the bear case 150 to 175 happens if growth decelerates, margins compress, or the market sentiment turns risk off. Now, what's my verdict? My verdict is this. Nvidia is still one of the best businesses in the AI world. It has a powerful platform moat, it's printing cash, and it's central to the biggest tech trend right now. But the stock is not risk-free because expectations are massive. So Nvidia is not a YOLO stock. It's a plan and discipline stock. If you're a long-term investor and you want AI exposure, Nvidia can make sense as a core position, but you size it responsibly. You accept volatility. And you focus on the fundamentals, not headlines. If you're newer to investing, you also need to remember something important. You don't need to own Nvidia to build wealth. Broad index funds work. Boring works. Nvidia is an optional higher conviction bet. If you want, I can do a follow-up video where I compare Nvidia to AMD, TSMC, and one software AI name so you can see the difference between infrastructure and applications. Or I can do a Nvidia explained in 5 minutes version for people who want it short. Comment the next US stock you want me to cover. And if this helped, consider subscribing. Thanks for watching.